This video tutorial will cover the topic of trust accounting process, specifically the components involved.
Trust money does not belong to the agent. It belongs to one of the parties involved in the transaction facilitated by the agent. The agent is entrusted to hold those funds for a period of time until the transaction is completed. There are two types of bank accounts that are used by an agency. The first is the general trust account, which is used when receiving or paying money on behalf of a client. This account will have money such as deposit for purchase of property going into it, tenant rent, tenant rental bond, vendor paid advertising if the marketing expenses are paid in advance and have not yet been spent, and also money such as commission for the sale of a property, which will stay in the trust account until there is authorization from the client or their legal representative to allow the agency to disperse that commission into the second type of bank account, which is the general account, which is agency money and is used for the operation of the business and the agency's day-to-day expenses such as wages, insurance, electricity, office rent, etc.
The first step of the trust accounting process is for the money to be paid into the trust account. These payments can be in the form of cash, EFT, direct transfers or deposits, and cheques. These are all valid payment methods and may be used to deposit money into the trust account. The next step is to issue a trust account receipt to the client or customer who has paid the trust money to the agency. Trust account receipts must contain specific information. This information is outlined in the state-specific legislation that covers the topic of operating trust accounts and should be consulted to ensure that trust account receipts are compliant with the legislation in the state of operation. Some examples of required information are the licensee name and license number. Also, you will see a title that it is a trust account receipt that is being issued.
Next, you need to make sure that the receipts are consecutively numbered, so you can't skip pages, you can't skip receipt numbers. It has to be the next consecutive receipt number from the previous transaction. Then you would put in the date that the money was received. Received from, you need to put in the information about who's actually paid the money. So if this was a tenant, you would put the tenant's name. On behalf of who it was. So if that was a landlord that it was on behalf of that you took the money, then you would put their name in there. And also you need to have their identified ledger number. So that might be their client initials and house number that they live at. You also have to put the description of what it was for. So if that was going to be, an advertising payment, and the property address. So you need to be able to determine what the purpose of the money was for. How you've received the money, so whether cash, EFTPOS, check, money order, direct transfer, how was it received? How much was received for that transaction? Who actually receipted it, so the name of the person issuing the receipt and their signature of the person. And they don't have to be anyone that holds a real estate agent qualification or be an assistant agent. This can be anyone in the office issuing the receipt, and they would sign off having received that money.
Whenever trust money is received in the form of cash or cheques, this money must be banked. Deposit slips are used when depositing cash or cheques into the bank account. These source documents serve as proof that the money has been deposited. The legislation outlines strict timeframes in which banking of trust monies must occur. Once the money has been received and banked, it needs to be recorded in the trust receipts cash book. All transactions from all properties will be listed in this cash book in numerical order for any given month. Once the money has been received and banked, it needs to be recorded in the trust receipts cash book.
So we'll have a look at this now. So the information that must be contained in a receipts cash book is the date that the money was received. So when did we actually get the money paid to us? And also the date that we issued the receipt. we need to put in the name of who paid it. So in our case, we've got W. Lewis, and we're using an identification code of Lewis 1L, and that'll be up to the agency to create these identification codes, which will be used throughout the cash books computer systems for that particular client to identify them. And we're going to put in the description of the matter. So what was the payment for? So in this case, we've got VPA advertising, so vendor paid advertising for an amount of $1,089. Receipt number we used was 10, and we banked it on the same day. So we would do that for every single transaction that we receive for that month. And then at the end of that month, we would calculate the total that we have received.
The next step after recording the receipt into the receipts cash book is to update the individual ledger that has been affected by the transaction.
So if we imagine that we're looking at the account of W. Lewis, ledger reference of Lewis 1L, which again is something that's set up by the agency. We look at the sale of 8 Origin Street, Brisbane. So that is the account of this particular client. And we can see that the opening balance was 0. We started at nil. And then all of these transactions have transpired over the course of this month for this particular client. So on the 1st of the 9th, there was W. Lewis we received an amount on a receipt number 10 of $1,089. Then on the 4th of the 9th, for ABC Signs, we had to pay out via check number 10 an amount of $330 on that client's behalf, and then we have a progressive balance left of $759. Following that, we also paid on the same date Photos Are Us by check number 11, the amount of $220, leaving a balance of $539. And then on the 4th of the 9th, we also paid for realestate.com.au advertising with check number 12 for $539, and so then we had a balance of 0. Then after the marketing, on the 20th of the 9th, we received a buyer deposit from D. Lockyer for the amount of $25,000. So then the account is once again in credit for $25,000. And on the 30th of the 9th, obviously settlement has occurred, and we are going to transfer the balance of the deposit, which was paid out of the trust account via check number 18, amount of $1,487.50, leaving a balance of $23,512.50, which was then dispersed on the 30th as well as the commission for the agency, which was paid by way of transfer of that $23,512.50, leaving that client's ledger at a 0 balance at the end of the month.
We will now look at the processes involved with money being dispersed or paid out of the trust account.
When money is due to be paid out trust account, it is very important that this withdrawal from the trust account can only happen only after a transaction is completed. So even if you know settlement is going to be happening afternoon at 2 p.m, you cannot complete the withdrawal from the trust account until settlement has been effected and authorization has been provided. Speaking of authorization, it says with client's authorization. Now, authorizations can come via various forms. Authorization might be to pay for a repair or maintenance item, and these would be paid by having authorization from the client's authority. So agency authority may have the authorization, or if there are amounts over and above, you would have to have a letter in writing from the clients. More information about this is contained in the learner guide for this module. And also it's the licensee or authorised person. So there can be someone else who is delegated the responsibility, and generally they will have to have it written into their employment agreement and also have the appropriate qualifications and license categories to be able to do this. The next step is to issue the trust check or transfer the money directly from the trust account to the client's nominated bank account. These are the only two authorised ways that you can pay money out of the trust account. You cannot issue cash out of the trust account.
Speaking of checks, if a check is issued, the business will retain the check butt. This is a part of the check. It is a source document that provides evidence of the transaction occurring.
So all payments for customers, clients and suppliers are made by way of check or a bank transfer.
Just as we recorded received money into the receipts cash book, all payments that are made out of the trust account are recorded in the payments cash book. Once again, all the payments are listed for all properties in numerical order to ensure all payments for the month are captured.
So once again, if I just go through the details, you can see that the information we have is the date that the payment was made, followed by how much it was that we paid out for $330 with a check number 10, and we made the payment to AB Signs on behalf of W. Lewis, which is the ledger that we've identified at the end, and the description for the amount that we paid out is a for sale signboard. So you can see that each of these is in order and how much and the check numbers, so that we have a paper trail that's going to correspond with all of these amounts that have been paid out of the trust account. These payment transactions that are being disbursed from the trust account are going to be recorded in the trust ledger for each client. In simple terms, a bank reconciliation ensures that the amounts showing in the trust bank account and the amounts in the trust account cash books are the same. The bank reconciliation needs to be performed after the month has ended, for example, the first day of the following month, to ensure that all of the transactions have been completed and no late transactions come in after the reconciliation for that month has been completed. If there is a difference between the amounts showing in the trust bank account and those showing in the trust cash books and the accounts cannot reconcile, this is the result of a discrepancy and must be identified and remedied as soon as possible. Let's look at performing a bank reconciliation. The first thing we need to look at is what is our opening bank balance. So have a look at the bank statement to see what is the amount that we are actually opening the bank balance with, and enter that in to your opening bank balance area. So in our example, we're going to use $10,000. The next thing that we need to look at is how much money have we received into the trust account for the month. We're going to assume that's another $10,000 that we're going to have received by way of rental payments, deposits for purchase of property, etc., which gives us the subtotal of our opening bank balance plus our receipts journal total of $20,000. We then need to have a look at how much money have we actually paid out of the trust account. So we will enter in our check numbers and the corresponding amounts. So I'm going to just use basic numbering of 1 through to 5 for the checks. And I'm going to say check 1 was for $5,000. Check 2 was for $1,000. Check 3 was $500. Check 4 for $2,000. 5 for $1,000, which gives us a total of presented checks of $7,700 for this month. If there was an amount that we had put a check forward and it had not yet been presented, that's where we would have it, another area of unpresented checks, so that we can ensure that we've accounted for that. And finally, we're going to tally our total of our incomings and take away our outgoings to give us a figure of a closing balance, which is shown in our cash books as $12,300. So that is the figure that we should see on our trust account bank statement. So we would have a look at our trust account bank statement and compare the two balance amounts to see, are they identical. If they're not identical, we would need to go through each of the transactions to find out where it is that we've gone wrong or what the amounts are that are not marrying up to work out where the discrepancy lies and correct it.
Let's now look at the trust account trial balance. The trial balance is a report run at the end of an accounting period, listing the ending balance in each ledger that has an account balance of more than zero. The report is primarily used to ensure that the total of all debits equals the total of all credits, which means that there are no unbalanced journal entries in the accounting system that would make it impossible to generate accurate financial statements.
If we look at this template, firstly, we would enter in our amount that we had reconciled from our bank reconciliation, which was our $12,300. And of course, the total for that debit column was also going to be $12,300. Over to the credit side, our opening balance for the month was zero, and then we have our Ted Johnson TJ02 as required by the legislation. That is the only active ledger for the month, with an amount of $12,300 remaining. So we list that down, and then we tally the totals being $12,300. Our total amount again being $12,300, which, as you can see, when we compare the debit and credit amounts, they are balanced.